All right, good morning, FX Street. How you doing? Oh, my computer turned off. Did it? Rolling. Morning, how are you? Morning, how are you? Morning, how are you? Computer went to sleep. Morning, how are you? Computer went to sleep. All right, ni hao ma. You guys ready to go? Yeah, boy. FX Street, 7:30 in the AM on Wall Street. 1 hour before Non-Farm Payrolls live. 2 hours before the open of trading. And we are going to spend this time together, just you and me, a sum on one. So welcome to Trade Non-Farm Payrolls live, month 211. If you're trying to do the math, that's about 17 and a half years that I've been doing this particular webinar with FX Street. Of course, I've been working with FX Street for longer than that. My first presentation was, what was it called? 50 Ways to Lose Your Lover? 10 Ways to Lose Your Lover? How to Exit a Losing Trade? Risk management? Yeah, think about that. My first presentation was risk management. Yeah. Also, when I did Bloomberg, I did Bloomberg Educated Investor for a couple of years, and they featured my feedback on risk analysis, risk management, which I thought was really cool. I'm like, wow, they put me in, and I respect that. So anyways, here we are. How are you doing? You know what, J-Man? I don't know why they put that there. I honestly don't know, but it's sweet. I got the key in my pocket. Got my finger on the trigger. In fact, I want to get it out of my pocket. It's too big. Look at the size of that legacy key. Crazy. All right. All right. So anyways, my name is Wayne McDonell. I've been, like I said, doing this webinar for almost 20 years. I've been trading Forex for over 20 years. I'm the Chief FX Market Strategist for Traders Way, a boutique foreign exchange trading firm that doesn't make money by trading against you. They make money by providing you a quality service at a fair price. And therefore, they value your education because they want you to keep trading for years and years and years and years and years and years successfully. So anyways, and FX Street, of course, when I first started trading, there was no education. There were no gurus. You couldn't go to Amazon and buy a book. And by the way, Amazon was a tiny little startup, and it only sold books online. That was the only thing you could buy. Amazon.com was an online bookstore. And if you went there and you typed in Forex, the only book you got was called Forex Made Easy. And I wouldn't call that an education. So anyway, so when I first started, my only resource to other Forex traders, the only Forex world on the internet was FX Street. And that's why I've been working with them for so long. I was one of the 5 people on the planet trading Forex as a retail Forex trader. They got bigger. Yeah, the very first Forex Trading Expo, I was a keynote speaker. So it shows you like it when all of this began at one singularity in the price-time continuum, and FX Street was at the epicenter of that. So anyways, thank you, FX Street, for being wonderful and sharing and bringing Forex traders together. It's grown from 2 trillion to $8 trillion a day. So what, 400% increase in that time period? Yeah, pretty amazing stuff. So today we have a thing called non-farm payrolls, and if you Google the government websites, you'll find that there is no such thing. It's called the Employment Situation Report. Yeah, the Employment Situation Report. And there's two parts of it. One is the Establishment Survey, and the other one is the Household Survey. And the government makes a couple of phone calls, ring-a-ding-a-ding-a-ding, and from a very, very, very small sample size. Like, for example, what's the date today? The 3rd? All right, so in the last 2 days, they've called people and companies, and they gathered information. How much information do you think they actually have in their data set? Hardly anything. It's only been 2 days. How many companies did they actually call? So this number that comes out today, the headline number, is really, really, really fuzzy math. So they call, I don't know, a few hundred, a few thousand, a couple thousand. And from that, they extrapolate what the entire economy of almost 400 million people are doing. Seems like in 2 days. Seems like it's bad math almost, right? So last month, we had, going from the top of my head, we had 336,000 jobs, way above trend. Well, it could be a mistake. It could be bad math. And now that they've had another 30 days to do their math, we'll probably get a better number. So today, look for a headline number that's not 336,000 jobs, but instead closer to the average of 180,000. Good morning, moderator. How are you? Okay. So the headline is likely to be closer to trend because that's trend is average with a linear projection. And then the second one is going to be like the revision from last month. That it was bad math to get 336, and it was probably more like 200. And so look for a big revision. Both of those things are market movers. Unemployment rate is probably going to stay the same. And then what? I believe we have ISM services today, eh? Oh, for sure, eh? So what a busy day. So make coffee. So let's go to the calendar and let's get that going. Oh, we got kitty cat jobs too. No, okay, that's not uncommon. And there's your services. Okay, cool. And then later today, we get our commitment to traders report, which I think I still have last week's report open. Is it out here? I know I saw it, but I just closed it. I had like 50 different windows open because I was doing fundamental analysis. No, I guess it's gone. Let me show you how to get that information. See, this gets updated today. I really want you to research this over the weekend. So you go to the Commodity Futures Trading Commission. This was established after World War II, when the government needed to use much of the resources, if not all of the resources produced by the economy, to support the war effort. So the military said, wow, we need X million tons of corn and X million tons of wheat and X million tons of this, that, and the other thing. And they asked industry, can you supply this? And they're like, well, we don't know how much wheat there is. We don't know how much corn there is. And the government said, really? Yeah, I guess not. So they started to track this stuff. Okay? So if you want to know about the diversity and inclusion of the CFTC, you can click a button here. Or if you want to gather all the intelligence of all this deep research, you can go here. All right. So you want to look at financial futures, long format, but you don't need the options. And that's it. So this will be revised today around 4 o'clock. And I will provide you with a link because I care for you and you're my sweet baby. So you could look at here, Japanese yen, traded on the Chicago Mercantile Exchange. Okay. You can look at the dealers, asset managers, leveraged funds, other reportables. So this is the new format. Here's euro. Look, euro, British pound. All right, Australian dollar. Okay. And you can look at long positions, short positions. Okay, the change, so on and so forth. Total change, percentage change. Isn't it nice? This way you could track the flow of broker-dealers or smart money, hedge fund managers. Okay, looking at the Australian dollar, 30,000 contracts long, 100,000 contracts short. Okay, 110 really. So 80,000 net short contracts. Okay, 30,000 minus 110,000. What do you think about that? Here's retail, by the way. Retail, 34,000 contracts short, 18 long. So, okay. Institutional investors are much more heavily short, right? 4 times short versus double. Okay, so institutional investors, smart money, significantly more short Aussie dollar than retail. What do you guys think of this? It's pretty, right? It's all the information. And of course, now what you want to do is then look at this month's, right? So you can go back to where did I leave my Aussie? There's Mexican peso, Australian dollar. So now what you want to do at 4 o'clock is look at this number and say, did institutional investors go more bearish or are they less bearish? Is the money flowing into the shorts or out of the shorts? And is it going from the shorts to the long or shorts to some other asset class? Isn't that cool? All this information. It's all out there. It's all out there just floating around. Huh? It's pretty, isn't it? E-mini futures on the S&P 500. Okay, here's your NASDAQ. You want to look at NASDAQ, right? Russell, 2000. Beautiful. Okay, bonds. The 2-year, by the way, the 2-year dropped below 5% today, huh? 4.99. As many of you know, I bought the 20-year bond at 5%, or roughly 5%. And it's doing great. Thank you. Thank you. You're far too kind. Thank you. Thank you. Okay, here's the 5-year. Here's Bitcoin, huh? Bitcoin, is money going in or money going out? Institutional investors overwhelmingly long Bitcoin. ETH, US dollar index, overwhelmingly long. Cool, right? You guys think this is pretty? Let me show you another way of looking at all this information. I own a company called Quant Box. And when you log into the cloud, Quant Box is on the Google Cloud, it pulls data directly out of the CFTC as a data table. So basically, it grabs all that data and it displays it like this. And this is all institutional data. So it's not dumb money, it's smart money. And the market is very heavily bullish on US oil, so WTI, the Nikkei, the Japanese stock market, the US dollar, gold, silver, and it goes all the way down, heavily short yen and heavily short Aussie dollar. We just looked at this. 78.0% short. Way nicer, huh? Okay. Right? So that you can see these changes. So you're like, how about the dollar? Okay. So the contracts long, contracts short, the change over time. Okay. Money is coming out of the dollar, both long and short. Okay, but still heavily long. Cool. And then there's something new, what we've added. Okay, something new. We take this data now and we summarize it. So like for the euro dollar, okay, euro is the asset long. So this is the number of contracts. Now it's net. See, it's long minus short. So green is euro. Again, all the bulls and the bears. So add all the bulls, subtract all the bears, and you get the net. So you can see there's been a slight increase in bullishness in the euro over the last 3 weeks. Asset number 2 is dollar, and dollar was ripper weak. Then it consolidated and then has gotten very strong. So now dollar is based on the flow of money into the futures market. The dollar is based on money, not sentiment, more bullish than the euro. And so then you scroll down here and it gives you a bias. These candles show long euro, 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 long dollar, long dollar, long dollar, long dollar. Okay? Because they're below, it shows it favors the dollar. Dollar is stronger than euro. Again, looking at institutional capital flows, they favor the dollar over the euro. And then the red line is the actual price of the euro dollar. So when the price started falling, you started to see the long euro position fading. And then right here, it actually became long dollar. So it explains what's happening. See, in the beginning, it wasn't long dollar. It was taking profit on the euro long. And then, okay. What does your template graphs talk about? Tell you about Bitcoin and ETH? You should probably pay money and find out. Okay. Now the truth is it's not here. But, and that's a big but, let me do something off the grid here. Hang on. I have an experimental page. Let me log into the Google Cloud, and I'll give you a sneak peek. Let's wait, I'm in the wrong database. Let's go to that one. Hang on, you can't see what I'm doing. And I'm logging into the Google Cloud. I'm going to then edit. So now I'm into the back office. And where is it? Manage pages. Page. Manage page. And I'll show you something experimental and radical and slightly dangerous. Are you guys okay if I do this? Slightly dangerous? Are you even ready? Can you handle it? Let me refresh you. Wait for it. I don't know. Be careful. You might not be emotionally ready. Hang on. It's like a roller coaster. No. All right. Same time, same place. What's new in the matrix? Crypto. What? Crypto. What? And it's only Bitcoin. But anyways, because we have to be able to get the data. You sure what I'm talking about? But let's take a look. It's different. I'm playing around with different things. Oh, it's different. Huh? It's different, but, so it's been built. I just haven't released it. I don't know if anyone even cares, but right now Bitcoin is neutral with a base case, best case, worst case linear projection. Best case 37,000, worst case 33,500. Wow. Okay. Although, what is this? 1, so 0, 1, 0, 1, 2, 3, 4, minus 3, yeah, is 1. Yeah, okay. So it's neutral. But looking at the CFTC data that I just showed you, okay, but I don't think you're ready yet. I don't think you can, you're not there yet. So I am going to say goodbye. All right. And it's gone. It's gone. It's gone now. I wonder if it'll work. Yeah, it'll still work. All right, so next time you log in, it's gone anyways. All right, so why don't we look at the S&P since we're here. Okay, seasonality, fundamentals, institutional positioning, retail positioning. Okay, add it all up, and it's very bullish. Linear projection all the way to 4,500. Yeah. Nice, right? Currently, the market is neutral. On a weekly basis, it went from bearish to now quite bullish. When you look at over the week now, over the last 7 days, Dixie is flat but slightly down. Okay, yields have come down dramatically. So, see, it's scoring, right? So, dollar weakness, that's good. Okay, yields are falling, that's good. Gold is up slightly, but not anything important, so 0. Yen is flat, so that's a 0. Volatility as measured by the VIX is down very significantly. That's good. S&P 500 is up very significantly. That's also good. So it's very bullish or risk on. In a risk on situation like we have now by analyzing all this stuff, again, the dollar, the yield, gold, yen, volatility, and the S&P 500. Looking at all that analysis for the week, buy the S&P 500, buy gold, buy New Zealand dollar, buy CAD, buy euro, buy Aussie. Yeah. Monthly, it went from very, very bearish to now fairly good. Again, even month over month. So rolling 30 days is really it. Dollar has fallen, that's good. Yields have fallen, that's good. Gold has gone up, not so good, actually. You should be doing something else with your money. Yen is flat, and highly volatile. That's okay. Volatility over the month has dropped. This was very high. Now it's dropped very significantly. That's a +1. And even month over month, okay, we're up 2%. Good, 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 good. So we'll see how today shapes up. This may move toward risk on, of course, or around a risk off. So it updates, right? If ever wants to know, like, what does it look like when you're looking at, like, Aussie dollar, you said? Okay. So when you look at Aussie dollar over the last 20 years, usually we're buyers this time of year. Okay? So that's where you're like seasonality. Usually it's long right now. That's why it gets a 1. Okay? So it's just giving a score that Aussie typically is outperforming the US dollar this time of year. So that's why 1 means pro-Aussie. If it was -1, it'd be pro-dollar. Okay? So interest rates favor the USD. Inflation favors the USD. Okay? So on and so forth. So you can see that over here. Australian GDP is only 0.4, where in the United States it's 4.9. Okay? Dollar wins. Okay? Inflation. It's 5.4 in Australia. It's 3.7 in the United States. That favors the dollar. And of course, we track the differential for you. See? The change. The triangle means change or differential. Unemployment. Look at that. Aussie's 3.6. The United States is 3.8. That goes to Australia. See? Interest rates, 5.5 in the US of A and only 4.1 in the United States of America. So that favors the United States. So anyway, so you add it all up, and it's just ever so slightly bearish, you would think. But remember, even though this is the 10-year, see, this is the 20-year, this is the 5-year. So the 5-year and the 20-year say up. And this is trying to come around anyways. So this is showing you that even though you have an eco score of this should be down, what Quant Box is telling you is, yeah, it should be down, but it's almost always up this time of year. And it even seems to like there's a normal pattern that we can't see. Like there's a reason capital is flowing this way. Do we know, is it all economic? Is it geopolitical? Is there a reason? Does China typically buy iron ore and coal from Australia this time of year? And because of that, the Aussie goes up? Is it that this time of year, money flows into the United States stock market and creates a risk-on mode? Is this when the United States imports more and weakens the dollar? Like, even though there's eco data, there's still market data, right? And there's sentiment as well. And so even though you would say this should be down, this time of year, it's usually up. And that seems to be what's happening. Okay? Now, let's talk about today. Okay, these are forecasts going out 18 months. This is the future. See, it's slow because it's not a website, it's a database. It had to generate all of this. Basically, every time we load this, it has to do the math. Okay. Anyways, let's look at what's going on today. Okay. This is the future of interest rates dictated by the Federal Reserve of the United States. Okay. We are currently here. And you can see the next one is higher, right? So the mean interest rate, 5.35, and the mean future interest rate is 3.43, followed by 3.43, followed by 3.43, followed by 5.18. So look, the Fed, right? We are forecasting by information from the Fed, one more rate hike, pause, right? Cut. And so this goes all the way out to 2025. So the news to pay attention to today is if there is a big number like we had last month. So we had 36, maybe there's almost no revision here. And right, so that's the last one. And the new one comes out 295. Well above consensus. Then that would tell the market the Fed does need to raise. We have this irrational euphoria right now that the Fed is done. The Fed never said it was done. So then the Fed was asked directly, are you guys neutral? And Jay Powell said, no, We're not neutral. We only decided to not raise interest rates today. We didn't agree to pause. We didn't agree we were done. We didn't even talk about cutting. We are still bullish, or otherwise known as hawkish. And for some reason, the media portrayed it as a dovish pause. It wasn't. That is completely wrong. It was a hawkish pause. So be careful who you listen to. So anyways, if the number comes out hot again, remember we're expecting $1.80 today. So if it comes out 250, 300, oh my God, the market's going to realize the Fed's going to raise one more time to this level. But we've known this for how many months? 6 months, 7 months, 8 months? And they've also told us when they're going to cut. We already know this. So again, in interviews and stuff, experts give opinions of whether they think the Fed is going to raise or not. They very rarely say what the Fed has actually told us. And then they're asked in the future, when's the Fed going to cut? When's the Fed going to cut? When's the Fed going to cut? When is the Fed going to cut? And they rarely say the facts. Oh, well, according to the Summary of Economic Projections released by the Federal Reserve, we see it here. They don't say that. They give opinion. So the next part of today's information is, will the data show that there's no cut coming? Now, we won't know this actual. So this would be, again, reading the tea leaves to say the Fed will raise one more time. That's what's going on today, by the way. Will the Fed actually still raise? If the number is low, they don't need to. The job's already done. But if the number is high, they will raise one more time. And that'll strengthen the dollar, by the way. But what I'm really interested in, because really, honestly, does it matter if they raise 25 basis points or not? Does it make a difference, really? No. So who cares? What does matter is this. And I have a feeling this is going to shape out like, We won't know. We won't get the data. Remember, I'm not guessing. Quant Box doesn't guess. We won't know until December 13th at 2 p.m. And while everyone else is talking about this, that, or the other thing, on December 13th at 2 p.m., I will have that report in my hand, and I'm going through it page by page. The cool thing is for you, you don't need it in your hand. Quant Box will just update. It'll change the dots for you. Hey, you're welcome. And you're like, Wayne, how does that compare to Australia? Oh, shut the back door. That's a smart question. Or what about Canada? What about Switzerland? What about pound? We got it, baby. We got you covered, baby. Oh my God, it's so beautiful. I know. And then there's Europe, where they don't tell you anything. So Quant Box doesn't know anything. And I have a feeling it's because they don't know either. Market would be the other way around, if anything. Okay. By the way, here's interest rates in the future. Okay, interest rates in the future and inflation in the future. So you could say, what's interest rates and inflation going to be in the United States out at 2025? Interest rates will be 5%. Now, this is the mean. Some people will think it'll be 4 3/4. Some will think it'll be 5 1/4. So it's the mean, or actually, technically, I believe it's the median. But according to the Fed, again, this is not my opinion. This is not gobbledygook math that, my algo is doing. Oh, it's Wayne's AI. No. This is what the Fed has already told us. The thing is, even though the Fed has already told us clearly, 99% of traders and investors have no freaking clue because they don't do the work. Okay? Bunch of dumb jocks. A bunch of wild cowboys trading, but they're not doing the research. Okay? All right. So anyways, interest rates will be down, according to the Fed, by 2025. Cool. Inflation will be 2.4%. Okay? So we're kind of in this zone right now on our way down here. Now, the big thing is you want to like pay attention to GDP, because GDP, if GDP is higher, by the way, do you want a tip? I'm going to give you a tip right now, a trading tip. Trader's hack. Who wants a hack? Who wants to know something very sneaky? Like how to know when to buy and sell gold. Gold! Would you like to know? Okay. Then click the thumbs up button and show some love for FXStreet. Okay. Hang on. I'm going to log on to the page. I want to see lots of thumbs up. Remember, this doesn't benefit me. This is just showing respect for our host. There's well over 100 people watching and only 44 thumbs up. That's BS. That's rude. Your mother would be very disappointed in you if you didn't click the thumbs up button. My God. Huh? Do you tip your bartender? Do you tip your barber or your hairstylist? Do you tip your waitress? But you won't show some love for FXStreet being like the only source of legitimate research and information, and like, really? How disappointing. Yeah. All right. So we got that up. So thank you. Okay. Thank you for doing that. FXStreet, thank you for hosting us. We appreciate you. Thank you for being here for well over 20 years. Okay. Here's the hack on gold. You want to watch inflation levels and GDP. So you look at this and you have your expectations. We're at 3.8, dropping to 3.6, dropping to 3.2. Okay. By March or April of next year, we'll be below 3%. Now, you want to watch GDP as well. When GDP is higher, okay, when GDP is higher than inflation, you probably want to sell gold because productivity is disinflationary. So if your economy is doing 5% and inflation is only 4%, you're actually richer, which means for you, prices are actually lower. You don't need to hedge. When really, I mean, you have headline inflation, that's fine, but you're more productive than that, so it actually becomes irrelevant. So think of it this way. If every year you got a 5% raise at your job, it was baked into your contract. Every year you get a 5% raise, but every year inflation is 3 or 4%. Well, who cares? You still make more money. You make more money. You can afford everything. In fact, everything gets slightly cheaper every year for you, even with 4% inflation. So you don't need to hedge it. You're like, it doesn't matter. Now, productivity actually lowers inflation. Okay? Here's a classic example, this cup. But you know what? I've given that example too many times. Let me give you an example. Here's a self-locking 25-foot tape measure. Okay? If I make these, let's say I make 1 million of them, it's going to cost me a certain amount per unit. We call that microeconomics. Okay? The marginal cost, the per unit cost, if I made 1 million of these, let's say is $5. Okay? Now, if I double production, so I have fixed costs like my factory, if I decide to make 2 million instead of 1 million, my rent is the same. My factory costs, like I'm leasing machines, well, they're the same. Now maybe because I'm doing double shifts now, maybe my maintenance costs go up a little bit. I got to hire some people, so those costs go up. But then all the material, I need some steel, I need some plastic for my injected molding and stuff like that. So I call them up and I'm like, I want to buy twice as much stuff from you. I need twice as much polymer. I need twice as many rolls of steel. I want twice as much. Can you imagine? You're going to get a better deal from your suppliers, right? They're like, oh my God, what are you guys doing over there? And like, well, we're going to add another shift. We're going to do a day shift and a night shift, and we're going to make 2 million of these. And they're like, awesome. We'll give you a discount. Because we know this economy of scale. You have many fixed costs that stay the same. You have some variable, but it goes to the per unit cost. So if you have twice as many workers but make twice as many, then that stays the same. So then ultimately it comes down to your suppliers' economy of scale. And your plastic and steel suppliers, they give you a huge discount for doubling the order. And ultimately, this goes from $5 production cost per unit down to $3.75, a 30% decline. I doubled productivity and lowered my cost per unit. I doubled productivity and lowered the inflation by 30%. I doubled productivity and lowered inflation. So if GDP is higher than inflation, you probably don't want to own gold. There's nothing to hedge. Okay? But if inflation is higher than GDP, so right now, as you can see, the United States is way higher GDP at 4.9%, way above the rest of the world. Okay? Way above, right? Everyone else is at 0. The United States is at 5. Okay? Now, if GDP now in the United States falls below, where were we? I guess I can go here. If inflation falls below, if GDP falls below inflation, rolling. Bring it up this way. So here we are right now in the United States of America, okay? And we know GDP is 4.9. So if GDP falls below 3.5, you probably want to buy gold. Oh, snap. That's amazing information, Wayne. Thank you so much. Hey, you're welcome. I love you. You're my sweet baby. Cool. Rolling. All right. So anyways, we got a jobs report. Okay. And I'll skip all this. By the way, why don't you take a trial? Quant Box, the trial is $8. Did you know that? Take the trial, my friend. Okay, take the trial. It's $8. Don't be afraid. You're not going to make me so rich with your $8 trial that I get a yellow Lamborghini and you don't get one. This that I'm showing you is expensive to build and to manage. You're only contributing to what I've already invested. You can, by the way, you can just get a Bloomberg terminal. It's $1,000 a month to do your fundamental analysis. Quant Box is cheaper than $1,000. Anyways, so I already told you, but let me restate it for those that are sauntering in late. If the number is big, that's going to be bad. Okay? Because then the Fed will have to do more to cool the economy off. That would be raising interest rates one more time. We already know that to be factual. I just showed you. The Fed told us this 6 months ago. But yet most of the market still doesn't know. Or they're guessing or betting. I do not like guessing or betting. Okay? I'm not a degenerate gambler. Okay? So that's what we have baked in. The rest of the world says, oh, the Fed's done. Everybody buy the stock market. Everybody go, 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 go. And then we might find out in 5 minutes that, well, maybe they're not done. And now everyone's like, oh my God. And then they freak out the other way. Just not cool, man. Just not cool. So a big number, a good number will be bad. And a bad number will be good. What's a bad number? Anything below 200,000. Was that right, Kyle? You're paying the 2,500? Yeah. Yeah. Well, therefore, maybe I should raise prices to on Quant Box, huh? Yeah, I'll raise it all the way to like $85. Yeah. It's going from $79 to $85. Yeah. So anywho, look. So anything less than 200, because I believe FXStreet is reporting that 180,000. So if it comes out about that, that is not 336. So everyone's going to say, oh my God, it's working. But if it comes out like 120, yeah, the stock market's going to rally. That's a horrible number. The stock market's going to rally. It's going to be risk on. Risk on, baby. Okay. Now, the other thing to look for, and I mentioned this before, but I'll mention it again for those who are sauntering in late. And by the way, if you're sauntering in late, click the thumbs up button on the FXStreet YouTube channel. You're like, I don't know the FXStreet YouTube channel. Try like youtube.com/FXStreet. Yeah, try that. That's a good start. Me. All right. So anyways, if it comes out bad, that's good. But if it comes good, then that's bad. Now, Richard's like wages and all that kind of stuff. Yeah. We'll get into that in a bit. Rolling. So let's go FXStreet. FXStreet, yeah. The best calendar on the street is FXStreet. Oh, what about that factory place? That sucks. All right. Okay. So we will get the news there. Rolling, rolling, rolling. Look at this beautiful calendar. Beautiful thing. Rolling, rolling, rolling. Do-do-do. 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 And don't forget kitty cat. Don't forget the kitty cat. We got kitty cat jobs. Rolling, rolling, rolling. Be-do-do. Do-do-do. Do-do-do. Okay, 336, $1.80 expected. You guys excited? Are you excited? I'm excited. What do you guys want to trade? What do you guys want me to watch? What do you guys want to watch? Euro dollar, pound dollar, biddy. Here it comes. Here it comes. Oh, it's horrible. It's so good. Oh my God. It's horrible. That's so good. Boom. It's a horrible number. Congratulations, everybody. It's so bad. It's so good. Yeah, baby. Yeah. S&P. Let's zip over. I want to look at all of them. Give me all of them. Rolling, rolling, rolling. Let's take a look. I don't know. Looks like Dow might be up. Guess I got to remove my hedge. That's not a bad day. Rolling, rolling. Okay, NASI up. S&P up. Dow up. Love it. Huh? I love it because everybody's getting rich. Love it. Right? Rich people and wealthy people own a lot of stock. So if you're middle class or above, you are getting paid today. Huh? You're going to go to the Walmart and buy something you didn't even plan on buying. Okay? That's what makes me, some people, or if not most people, middle class. You go somewhere and you're like, look at that. I didn't know I needed it, but I want it. So I'll buy it because I have the money. That makes you rich, but it doesn't make you wealthy. Okay? Rich people die poor. Why? Because when they stop working, they stop earning. Who's going to pick the apples when you're dead? Doesn't matter how many apples you pick. Doesn't matter what price you sell them at. Doesn't matter how big your apple picking house is. If you make money by picking apples, you might be rich, but you won't be wealthy. So that's the topic of my new book. So anyways, wealthy people are loving it. And even rich people are loving it. It's a good day for them because it's going up. Would anybody buy a book if it told you how to go from poor to rich? Problem is, I don't want you to become rich. I want you to become wealthy. But you can't become wealthy if you ain't got no money. So we got to figure out how to get you money first so you can stop being poor. I grew up poor. I was raised poor. Poverty sucks. Do you remember the line from the movie Wall Street? There's no nobility in poverty. Okay? Well, that's the thing, Lewis. He brings up a good point. And I think what you mean is you're both poor and rich. And rich people are just a different form of poor. They're poor with money. Quite literally, they're poor with money. So there's something that needs to happen to take you from rich to wealthy. Yeah. Cool. So anyways, that's great. By the way, the book is called Poor, Rich, Wealthy. Yeah. Okay, Bitcoin had its initial risk-on move, but it's got to get through the chop. Probably will. Okay, what we also want now is revisionary data. Where'd my report go? All right, it's going here. Rolling. Not there. How did Canada do? Sorry, Canada. Ooh. Get that out of the way. So unemployment rate went up. Yeah, I'm going to have to read this later. On Hell says, why does negative report mean good news for investors? Well, I explained it before, but let me do it again. It's behavioral finance. If the number was good, like 300,000, then it's implied the Fed will have to raise interest rates one more time. And that's bad because of the capital asset pricing model, which says, okay, the expected return of a stock is equal to the risk-free rate of return plus the beta of the expected return of the market, like the S&P 500, minus the risk-free rate of return. So if the risk-free rate of return goes up, then the stock market falls. So if the economy was good and did plus 300, then the Fed's got to raise the risk-free rate of return, which lowers the expected return of a stock. Now, in my stock trading course, what I do is we use this modeling to help us do valuations as we invest. And then what you can do is, you use your expected return of the stock and you do best case, base case, worst case analysis, okay? And from that, you start doing the expected returns for, let's say, 2 or 3 different stocks applied to the capital asset pricing model, and then see how what the expected return is under each condition of base case, best case, worst case. And then what you want to do is then take those expected returns and calculate the variance, which we call sigma squared. And then once you have the sigma squared calculated, and of course I do this in the stock trading course, then you take the standard, right? You standardize that deviation, which that variation is just deviation from the mean. So you standardize it by taking the square root of the sigma squared, and you get your standard deviation for each of the stocks that you're analyzing in each of the scenarios, and you can find the best utility. Not a utility stock, but the stock that performs best relative to the risk that is associated with the investment. Per unit of risk, what is your return? Oh my God! Yeah, now I'm just flexing. There's no doubt, Sky Killer flex. Flex, I got my Harvard Crimson on. Yeah, totally. So anyways, take the freaking course. Pardon my French. It's good. I'm telling you, it's good. So anyway, so on Hal's like, so why the down? Well, as I showed you, as the risk-free rate of return goes up with the increase, or the expected increase of interest rates by the Fed because of the big number, then the stock market falls. And right now, the reason we rallied for about 3 days is the market assumes that the risk-free is stable. And in 6 to 9 months, the risk-free will actually be less. So stable and then down and not up, all say the same thing. Not up, stable, and then down, all say what? Okay, the expected return of the S&P 500, for example, is equal to up. Okay, in the beginning a little bit, and then into the neutral a little bit more, and then when they cut, a lot more. And it changes, right, the velocity in which you would have a rising expected return. And again, it's just this month. It's just month, right? Okay, so on Held, it's behavioral finance and math. Okay, and in the stock trading course, guys, there's a lot of math, but I'm not a mathy person. But I've done all the courses. I have all the degrees. I don't like doing the math, but I get it. So in the course, I explain it, and we do the math together. But ultimately, I just want to show you the math so you know that like it's a logical foregone conclusion, that it's not magic. Okay, there is reason. And so I do the math with you, but ultimately, like I get to the point where after we look at all the different variables and the different stock investment opportunities, we get down to a point where there's a column. And you see, like, let's say a column, A, column B, column C. Let's say column D is standard deviation, and then there's E and F and G. And you're analyzing stock number 1, stock number 2, stock number 3, stock number 4, or it could be investment into a private company, investment into a public company, investment into a real estate, right, project, or an investment into a Forex trader. And you have all these, right, all these columns of maybe like risk, volatility, expected returns in a bullish market, expected returns in a bearish market, all these different numbers, right? And what I'm going to teach you is you might go to like this column here, let's say, for example, and just go, yes, maybe, no, and absolutely, totally, definitely not. Not that because you did the math to do all this, but you understand what this column does because we did the math together and I taught you. And now you might look for this in your screener, in your stock screener. Or in your analysis, you're like, I'm going to start my analysis with, filtering out investment opportunities with standard deviations that I don't think are appropriate for me. And so I help you answer, like, which is the cheapest stock, the $8 stock or the $80 stock? And you know it's a trick question, of course. You're smart enough to know that, but you may not know how to do the math. And that means you pick stocks randomly, not logically. And you know I'll show you the $80 stock is cheaper, but the thing is, you know it's a trick, but you don't know the methodology on how to prove it. Therefore, if I just said, here's 5 different stocks, opportunity 1, 2, 3, 4, 5, which one do you do? And you're like, I don't know. The one with the nicest MACD, right? You're like, yeah. So I will teach you. Yeah. Cool. All right. So my WTI, just beautiful. We've set this all up in the past. Cool. Okay. Let me explain it to you this way. What I've been saying for a week and a half. That's what I think. So the next part of this is you can't buy it now unless you're silly. Okay. This is the next play. You're either already in it, like, look, dude, obviously, or you're going to be in here in the future, obviously. And if you buy it now, after the news, you must capitulate and admit to yourself you don't know what you're doing. Okay. Oh, I forgot. I can offer you guys something for free. I forgot about that. What is the URL? I might have to search my own email. Is it going to be here, investor? Check out CIA. No. Let me log in. Let me give you a free lesson from that course that just goes over all the material actually I just gave you, but in great detail. You guys want a free 90-minute lecture on this kind of stuff on how to pick stock? I have it. I just, let me find it. What, I guess it's under, is it a, I think there's a landing page. Let's see. Oh, stock trading course free lecture. All right, that seems to be it. Edit, share, copied. Yeah, here you go. Yeah, free. Which stock is more expensive, $80 or $8? I asked her. Here you go. Free. It's about 90 minutes. Here you go. It's not bad. Okay. Rolling. Well, Richard, because I'm a macro trader, I'm taking a macro point of view to trading stocks. So, you know, we're not going to the homes of CEOs and digging through their trash and their garbage in their back alley. Okay. And trying to figure out, you know, their strengths, their weaknesses as a manager, and that particular company's product to beat its customers' products and take over like that. No. No, it's macro influences. So what do you do when the Fed is raising interest rates? What do you do when the Fed is cutting interest rates? What do you do when there's a global recession? What do you do when there's a global asset bubble? What do you do when, okay? And it leads to the question, really, ultimately, not which stocks to pick, but how to construct and manage a portfolio. Okay? And that's a macro issue. Okay? You got to remember, I'm a venture capitalist, or a former venture capitalist. I think picking stocks is stupid. Well, that's a bit of a stretch. But, you know, when I picked projects to invest in as a venture capitalist, they're private projects. Like when you look at, should you own a one particular company over another particular company, the management team is incentivized to lie to you and maybe even just lie to themselves, because their entire compensation package comes down to the performance of the company on the very short term. And everybody's incentivized to at least lie to themselves, but even if they realize things are not going to so good, they'll lie to you because they want their stock price to come up. And even then, I'd rather pay 50 cents for a stock than $50 or $500 for a stock. I'm like, because when you look at Apple or something, so Apple's like down 3% today, but it's still probably something like you have to pay for 36 years of earnings for your stock. You're like, you're paying 36 times earnings? Oh my God, it's so stupid. Oh my God. It just, So, because that's where I come from, you know, like, where's the deal in that? Oh, well, it's going to go up forever. Okay, sweet. Okay, because your iPhone 15 isn't good enough, you're going to need an iPhone 16? So anyways, I'm a macro guy, and I'm interested in constructing portfolios, okay, that lower your volatility, okay, produce income, and over time, grow your net asset value. But on the short run, actually, I don't care about it at all. It's way out there in third place. So high income investment opportunities. That's not even the first one. I'm not even interested in that. The number one goal of the portfolio is to lower my volatility. That's it. So if the S&P falls 10%, I want my portfolio to drop 6%. If I can't prove that, I'm not interested. Pass. Oh, but it produces a lot of money. Pass. Not interested. Already have a lot of money. I need more. Yes. But not at the cost of risk. So something with a medium vol or a high vol just increases my risk. So I make 100% a year for 3 years, and then in the fourth year, I lose 100%. Well, who cares? What was the point? Okay. So I have to lower my volatility first, and then I have to earn income because my income is a hedge. So I want to lower volatility less than the S&P 500 and then hedge. What the? You're kidding me. That is so ridiculously conservative. I know, right? Means when I'm old, my money will still be around. Sweet. But over time, I want to invest into companies I believe are real companies. So in 20 years, will the companies I own be worth more than they are now? Yes. Will they produce income along the way? Yes. And during times that are tough, will I survive the tough times? Yes. Sign me up. Okay. So that's kind of like the stock trading course is going to that direction. And I got to giddy up because I got to get there in the next 10 hours of lecture. So I got to hurry. So I'm going to teach you how to project an economic recession before everybody else, so that you can protect your money before the market crashes. And more importantly, get back in at a time when everyone just figured out they're in recession. You think like, actually, this is the ultimate, like, get rich. The first move, getting rich is just money, but how do you get rich in stocks? Knowing when to get out before a crash, and it won't crash until everyone else just figures it out. Oh my God. Well, you're already out, or you're already hedged. So when everyone else is like, oh my God, zombie apocalypse, it's the end of the world, you're already out. Your money's already protected. And then when there's total panic, chaos, anarchy, and as Warren Buffett said, blood in the street, ankle deep. Well, you're the one with money. And you start buying everything up for cheap. And that's how you do it, by the way. If you miss those opportunities, if you just look at the stock market over the last 30 years, and you don't get out during the decline, and you don't get in at the bottom, you don't make actually that much money on the long run. If you're more like a hedge fund manager that gets out at the turn before the crash and then gets in again at the turn before the recovery, knowing how to do that will make a dramatic difference to your returns. Okay? It's like, how did I know to sell everything right before the 2008 financial crisis if the 2008 financial crisis was unpredictable? You'll hear it all the time by all the experts. It was unpredictable. So then how did I predict it? How did I get out of real estate before the real estate crash? Why did I leave California, the Bay Area? I lived in San Francisco Bay Area for almost 20 years, and I left in 2007. Why? Oh, because the economy was going to hell in a handbasket. But when I was there, we were still in a bubble. So sold everything, moved. How would you like to know how to do that? Yeah, I'll teach you. Easy, easy peasy. All right, so let's move on.com. Let's take a look at the indices. Dollar down as expected. Risk on, baby. Swissy down. Risk on, baby. Yen down. Risk on, baby. So where's the money flowing? Even the pound, okay, is getting bid. Aussie, bid. Kiwi, bid. Euro, bid. Anything bid except Canada. Sorry, Canada. That sucks. Anyways, when you get this like this, when you get this, it's risk on. These are our three funding currencies. Okay, so traders are gobbling these three up. They're buying them, And you're like, but they're falling. Yeah, well, they're borrowing these currencies and then plowing them this way. Okay? So traders are borrowing Swiss franc and buying euro. They're borrowing yen and buying pound. They're borrowing dollar and buying Aussie. And you do that risk on. And there's no love for Canada, eh? It's because it snowed. Canadians are depressed. Huh? They're just going to stay home, vape, and drink Labatt's today. There's no day like snow day, like no day I know. Okay, so let's take a look at some of this stuff. Even the pig. Can you imagine somebody so desperate that they're buying the pound? How horrible. What a terrible currency to own. It's beating the Canadian dollar, though. Holy smokes. It's beating euro. Wow. So a giant counter trend move. Okay, pound Swissy's been going on for a while, and it's through the target, actually. And holy smokes. But I spent 9 or 10 hours last week analyzing the pound, fundamentally. Yeah. Yeah, I did. And there's nothing good going on. Wow. Wow. Like, it's terrible. The UK is in a terrible economic mess. Terrible. It's shocking. There was a bit of a flex done by the UK. I forget what the number was, but I believe, was it manufacturing or something? But anyways, their PMI, one of their PMIs, because, you know, there's many PMIs and I look at them all. One of their PMIs was 38, and they were bragging because it increased to 41. 50 is contraction. 41 is horrible. But they're like, yeah, well, it used to be 38. And you're like, 38? I didn't even know that was a number. You had a 38 on a PMI, but they're like, yeah, but now it's 41. 41 is crisis. And they're reporting an improvement. And you're like, that is staggering. And then you look at the United States in comparison is 51 or 54, you know. The only thing as bad as the UK right now is Germany. Huh? Germany, man, German manufacturing, when you look at their PMI, it's just horrible. Horrible. Like we're talking about a hard recession. Lovely, with your smile so worn and your teeth so green. All right. So CAD, so this is something I wouldn't trade, but it's definitely something going on. Yeah. So look at the trend clearly outlined for you. This, why don't we remove this? Oh, I killed it. Shoot. All right. So I have a proprietary tool, which I give away for free because I'm that kind of guy. Oh, well, I should preface that. If you're a member of Investor Bootcamp, you get it for free. All right. Insert indicators, custom, and it's price action pivot points. This is an invention of mine. Beep. Nice. Okay. It's a combination of standard deviation and linear regression. And what I realized, what I'm trying to do, is I thought hard about the math behind pivots. And pivots are based on market. What happened in the previous market? And then it does essentially a combination of linear regression and standard deviation. Well, mostly standard deviation. It's doing a form of standard deviation. Okay, based on what happened in the deviation of the last market, you take you standardize that deviation and apply it to the future market, like the right? So let's say you just finished October and we're just starting November. Well, pivots look at what happened in October and look at the deviation and then standardizes the deviation. So, right? And then applies that standardized deviation to the new month. And then we base our projections, right? And I thought, well, that's cool, but what if we didn't do it on market, but instead we did it on dynamic pricing? What do you think of that idea? There's somebody sitting around thinking about this, huh? I'm like, what if we did it instead of on market, but we did it on price? And okay. And that's what this is. So it's essentially a pivot point, a buy zone, and an exit zone. Not necessarily a sell zone. Oops, exit. Okay. And it's based not on the math. No, that's pivot points. But there's two different maths in this. Okay. And therefore, it's giving me the information I need. So for example, if it did something like this in the near future, these pivot points are updating after every candle. So at some point, okay, these price action pivot points are going to level off. And then at some other point in the future, it would become bearish, you see? Versus staying bullish in a bearish market based on pivot point analysis. So anyway, so it's nothing like pivot point numbers. It's completely different math. There's two math sets, actually. Two different calculations going into this. But nonetheless, it's dynamic, so every candle it updates. And of course, you can change it, right? So you can go in there and you can change it and say, give me shorter term analysis. Okay. But that's a very obvious trade anyways. So my thought is it's going to be north again, and likely it'll do something like this. Whoop. The problem is many traders don't know that they should be buyers down here. They just don't know. They change their mind 20 different ways, and none of them are logical. So you need just better tools to help you frame your decision-making process, right? So that's why I go in here, and this is my standard setup. Okay, it has to do with math. Hang on, it's calculating. Rolling, rolling, rolling. Okay. I think it's loading. Did I not click? No, it's loading. It has to do the math. There's a lot of math. Okay. And now maybe it's just easier for someone to say, oh, in the green zone, I should probably consider buying. Uh-huh. Yeah. Yeah. And amateurs just lose sight of stuff like this. They just don't know. So they're long, they're short, they're short, they're long and short, and it's a bloody mess. It's like a chicken with its head cut off, just running around aimlessly, making a bloody mess of everything. Yeah. Cool. Nice speech, Wayne. Thank you. Yeah. Okay, oil coming down as expected. Are you going to buy the dip? What are you going to do with your life? I want to rock. Okay. Okay. Remember, when we were up here, I said, if you buy it now, you just don't know what you're doing. You're welcome. By the way, these headlines that are tickering, scrolling below us, they're all headlines from FX Street. FX Street's really looking at that going, really? You got all, these are all from FX Street? Uh-huh. Yeah. Yeah. Hey, you're welcome, FX Street. That's how the Wayne do. All right, so anyways, interesting. Cool. All right, yeah. Good. All right. Let's shift a little bit. How many people here would like some personal feedback? Some personal advice on would you like some personal feedback on your trading ideas? Would you like me to look over your shoulder and say, hey, what are you doing? What do you think about this? Well, here's what I think. Give you some feedback. Kind of like a mentorship for free. Only technical analysis. So, post a trade plan here. It's free. There's no monetization whatsoever. None. There's no advertising. There's no email marketing. There's no subscription. There's nothing. There's literally, I have no way to monetize this. It's 100% free. It just cost me many thousands of dollars. So instead of driving a yellow Lamborghini, or at least instead of driving a yellow Hyundai, I built this AI. And so anyways, if you post a trade plan here now, in a few minutes, I'm going to go through and give you feedback, and I'll show you it's completely anonymous. There's no name. There's no profile picture. There's no association with any of the accounts. Completely 100% anonymous. Okay? So here's the thing. You post a trade plan, my AI will give you feedback instantly. It'll be in your email account in less than 3 seconds. But what I'll do today is I'll look at this account, and again, nobody knows it's you, and I'll give you feedback on your trading idea. I'll give you feedback on your technical analysis. I'll give you feedback on your trade. Okay? And so right now we can look at this euro-dollar trade, euro-yen trade, a gold trade, pound-dollar trade. I'm going to review them all in just a couple of minutes. So Helen Wheels, Helen Earth. Yeah, go ahead and post, and I'll give you personal feedback. Okay. Cool. And of course, you get AI feedback as well on your trade. Dude, it's amazing. Okay, so I'll watch that as some trade plans come in. In a few minutes, we're going to, in about 15 minutes, we're going to get the stock market open. And at 10, we got ISM services. Ooh la la. So between now and then, I want to do the technical analysis. Okay? Morning, Ed. Rolling, rolling, rolling. What else we got going on? Obviously, this is Brent, by the way. We topped out on Brent at 96. Nobody wanted to get to 100. And then we bottomed out down in here, which I can make it a little lower, I suppose. Okay, this goes back in time. But nonetheless, here's what I stink. This is what I stink. Oh, wrong color. Okay, I stink this. Okay. Smell like a plan? Yeah. If you got a problem, I'll solve it. Check out my hook while my DJ revolves it. Yeah. Guess we can go like that. Do I analyze gold? Yes, I do, Danny boy. Normally I don't, Danny, but for you. So let me open this up. Tradeplans.ai. Go here, futures, pick your asset, gold. Are you going to buy it or are you going to sell it? Put in your entry, your target, and your stop, and give me a screenshot. Okay? And hit submit. That should take you, what, 30 seconds? Probably less. You're like, Wayne, I don't have screenshot software. Wayne, I don't know how to use Windows. I don't use Windows. Wayne, how do I do a screenshot? Well, even if you don't know all of that stuff, you can also go save as a picture. Okay, you want this active chart? Yeah, I do. Do you want it to be smaller so it's not ginormous? Yeah, sure. All right, boom. Okay, now you want to label it Brent Crude 4H. That's good. Done. What's the big deal? Now upload that. Okay, so see that? That's my Brent Crude. So if I remember where that is, you go choose file, and it's under pictures, I believe, and under screenshots. There it is. See? Brent Crude 4 hour. See? It's not hard. Brent Crude, let's say, okay, but the problem is I don't have Brent Crude on here. We have to, so like the way this works, the way the AI works is I pay money to a provider of the data and they're all formatted different. Stocks, Forex, futures, crypto, they're all formatted differently. And we get like the 15 minute, the hour. Do we get a 4 hour? I think we have to create the 4 hour. So then we do 4 hour times 4 to get the 4 hour. And then we get the daily. Okay. For each one, there's tables for each and calculations to make the 4 hour. And then we have that. And then the AI creates its own charts because now it has all of this. So it creates a short, medium, and long-term chart by doing its calculations of candlestick data. Again, each one formatted differently. So there's a process in which we have to format all our data on all time frames using all this candlestick data, which we have to pay money for. And then you create a short, medium, and long term. So now we actually generate our own candles, and then we generate our own moving averages. We generate our own linear regressions, generate our own standard deviations. We create, what do you call them? They're multi-dimensional. It's a multi-dimensional framework for predictive analysis on the direction of the market. You might, if we drew it on a chart, you're like, oh, Bollinger Bands. No. But anyway, so we do a lot of calculations, like very, very deep technical analysis, and then generate a chart. Again, we generate it. We don't pay like a charting package to generate a chart. We generate our own through the math of the candlestick data, and then apply the algorithms on multiple time frames. And give you feedback on your setups. Now, the interesting thing is, for some reason, our data providers can't get us oil in complete data. Like the data is incomplete. And it would create errors, basically, right? And so we're working with that data provider. But put it this way. There's probably millions of data sets to get you this stuff. So you're like, oh, Wayne, so do you have 20 years or whatever? Do you have 5 years of ETH prices? Yeah, for every 15-minute price, every hourly price. Then we calculate the hourly and multiply it by 4 to create yet another column now of the 4-hour average prices of Ethereum. And then daily prices of Ethereum. And then format them into the AI, then put them into the AI, then do all our technical analysis, which is many different calculations and very complex calculations too, and then generate charts from the numbers, and then show some of the analysis technically with lines and colors, so it means something to the human, and then explain it using the English language. Dude, this is like freaking amazing artificial intelligence. It is amazing how complicated it is. And it works. So if you post it, yeah. But unfortunately, right now there's no oil. But we've been working on it for a while. And I suppose if I spent another couple of $1,000, I can get oil on there. So you can do gold, silver, and oil. The thing is, I'm paying for all of this myself. Now, that's just to get the data. Now, all of this lives, the artificial intelligence. Some of it is AI we've built. I pay for ChatGPT 3 or ChatGPT 4, whatever the new one is. I pay ChatGPT for that to translate the algorithms into English so it can basically, well, right now it writes the feedback to you. But and you know, we've taught it how to read our analysis and then explain it to you in English. But the next thing is I actually want it to talk to you. And that, but again, that would probably cost me another, probably 25 grand. And I can get this sucker to actually ping your cell phone and say, Hey, Danny, you should move your stop. Can you imagine you got a text? Hey, Danny, it's Aiden at tradeplans.ai. I've been watching your trade for you. I think you should move your stop from this price to that price. I think if I spend another 25 grand, I can get that done. Right now, it's free. So anyways, that's where we're going. Can you imagine how many people would like that? Like you enter a trade and the AI watches your trade 24 hours a day, 7 days a week, pings your cell phone and says, hey, bro, something's happening. Okay? Something's happening right now on your trade. Oh my God. Right? So anyways, that's where I'm going. That's where I'm going with this. But right now, everything's a stalemate because it's free. Okay? Well, in this case, Bernd, it would be a text. So, but imagine now, imagine there's 2,000 traders and Aiden is watching 4,000 trades in real time. Dude, can you imagine? So what I was getting to is AWS. So Amazon is where Aiden lives. So Aiden, our artificial intelligence, he lives at Amazon on the cloud. It's like almost a real person. Aiden thinks and writes to you. And he lives at the Amazon cloud. And every time he posts a trade plan, I pay more money. Because he actually thinks. I get a bill. He thinks. It's weird. Like, there's proof. So you guys don't see it, but like, I got a bill like yesterday, I think it was. I'm like, well, I got to feed Aiden. That's his food bill, right? He lives, he eats. It's wild. So anyways, please use this because I'm spending money. Please use it. And at some point, it's going to get really, really good. Can you imagine the AI watching 4,000 trades each and communicating to each trader personally? Can you imagine? Paching. A private conversation between my AI and you by text message. And Aiden says, Jim, you know that Aussie dollar trade you're on? I've been watching it. And now is the time to move your stop. In my humble opinion. But he's also doing that for Danny. And Maida. And Hell on Wheels. And Ed. He's watching everybody's trades. Oh my God. I mean, isn't that exciting? And then just privately, and this is the part I love, because everything about tradeplans.ai is private. So like you get feedback via email and it's not posted anywhere. It's a private feedback to you on your trade. But now imagine a private conversation, a text message between you and my AI and nobody else. Maida, congratulations on that trade. You just hit your profit target. Great job. And you will respond emotionally to it. You're like, Aiden loves me. Right? Aiden gave me a high five on that trade. Yes. I mean, dude. So anyways, help me create this into a reality, guys. This is what an entrepreneur does with his free time. All right. Let's go back to where we was. Thank you for posting, by the way. We are about 2 minutes away from the stock market, from the open. So let's take a 1 minute break. We'll come back for the open and then I will give you personal feedback. But also it looks like about a dozen of you have posted. No, maybe not quite a dozen. Well, maybe. Yeah. Okay, maybe a dozen, maybe 10 of you have posted, which means you already have feedback on your trade delivered to your email address. So go check that out. I'm going to go get a drink of water. I will come back. We'll get the stock market open, and then I'll give you personal feedback, and then we got to get back for ISM. Oh my God, it's going to be great. BRB. Lovely, with your smile so warm and your teeth so green. All right, here we are. Too much? Actually, what happened is I got to sleep in till 6 a.m. or whatever. When did I get up? No, 5:40. I got to sleep until 5:40 a.m. today. So I've gotten a lot of extra sleep. Oh, so stock market opening, ding, 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 ding. Ding, 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 ding. If you got a problem, I'll solve it. Check out my hook while my DJ revolves it. Bum, 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 ba-da-dum, bum. All right, next move. Mark your lines, guys. Here's Nazi. Mark your lines. On this one, I'm going to do S&P differently. And then thirdly, what should we do? Should we do a different one on this one? Yeah, let's do price position trading. No, let's do day trading confluence bullish. Okay. And this is Monday's buy zone. Ha ha, ha ha, ha. Shut the back door. Yeah, so that might be interesting. We'll see if no diggity, no Dow does this. This is Monday's trade, by the way. If you show up on Monday looking for a trade, you've already lost. You've already failed. Because institutional investors planned Monday's trade before Monday, bro. Okay? Before Monday. Yeah. Nice dip on oil. Told you, right, Bernd? Remember when oil went up to that peak and I drove the line and I said, if you buy it now, you must capitulate and admit to yourself you don't know what you're doing. And then oil dropped like a ton of bricks with two hammers. Uh-huh. So I hope the right people heard that message. Oh, by the way, I had a thought while I was grabbing my Dr. Pepper Zero. If everyone in this chat contributed $100 to tradeplans.ai, there would be enough money to take tradeplans.ai to the next level where it could actually track your trades. It wouldn't be able to text you, that's another next level, but it could be able to update you or update your account. Like it would be able to, we'd be able to do something with the data, but it could then, we would be at the stage of development in which it would be watching the trades. And then what do we do after that? Well, there's a lot of different options, right? But like, that's how easy it is. If everyone here contributed 100 bucks, we would have an artificial intelligence that not just thinks about your trade in one moment of time, which is your trade plan, but it would continue to watch your trade. And I already know how to teach it to manage your stop. So imagine tradeplans.ai gets to the next point of risk management. See how easy it is? But then, of course, we know 90% of people will say, well, that's really awesome. I'd love it, but I won't pay 100 bucks. Well, then it never happens. It's weird, though, right? I mean, it's super awesome. Oh, that Dr. Pepper Zero is so good. All right, so Dow, no diggity, no Dow. Okay, that's, I think, the current trade plan. Now, of course, if that fails, and it probably shouldn't, but if it fails, I think what'll happen is back down toward the 200 and then up. Okay, that's probably it. So let me do something here. Now that the market's open, I have to change a position. Hang on. I could do it from my phone. Scan my fingerprint. Lovely. Okay, I am going to... Ooh, yeah, nice open, baby. Nice open. Me likey. All right, hang on. Where is it? This one. Okay. Sell that position. Sell it all, baby. 250. Sell 250 shares. Preview. Dump it all. Huh? Look at that. Boom. Dump it all. Dump on the open. It's out. It's done. Your order has been placed. Sold 250 shares. Yeah. Boom. Boom shalakalaka. I kicks the flavor because Stephen King writes horrors, right? Anyways. Neato. All right. Let's roll over and do, let's take a look at some of these yen pairs, huh? Oh, no. Yeah, okay, we're going to do some yen pairs, some Swissy pairs, and then we're going to do, I'm going to review your trade plan. So last chance for your tradeplans.ai. Post your trade plan, tradeplans.ai. Okay. Oh, yeah, Danny. I just saw the conversation between Jim and Danny. Danny, this webinar, the one you're in now, is a monthly webinar. This is the 211th month in a row I've done this webinar for FXStreet. So I might be a knucklehead. I might be a loser. But I'm trustworthy because that's almost 18 years, Danny. This one webinar with FXStreet, the most trusted source of foreign exchange information in the entire world. Okay? I started this webinar in conversation with the founder of the company, you know, like, yeah. So Yeah, so whatever. Yeah, Sky Killer, what is that? Like the London breakout? I used to laugh at that stuff. All right. So anyways, let's go back to the yen. Okay. Best performer typically in a situation like this. Now, best might not be greatest performer, but let's say most reliable based under these market conditions, which we now consider to be risk on. You got to remember euro, okay, is important because euro, USD, right, is 40% of the entire foreign exchange market. According to the Bureau, no, the BIS, what is it? The Bureau of International Settlements, which is a central bank for central banks, and central banks are banks for banks. Okay? So banks have a central bank, and central banks have a central bank, the BIS. So the BIS knows everything. And according to the BIS, these are the guys that actually settle your trades, ultimately. 40% of the entire foreign exchange market is simply euro dollar. So follow the stream here, follow the thread. In a risk on move, dollar is heavily impacted. The dollar is the reserve currency. So in risk on, the dollar falls. Don't ask me why, I can explain it, but just go with it. Just stay on track here. In a risk on mood, which we are now, dollar weakens, and therefore if the dollar weakens and euro dollar is 40% of the entire foreign exchange market, then irregardless of what's going on in Europe, euro looks like it's going up. Okay? You see? So you're like, but that doesn't do anything for this pair. Yeah, it does. Indirectly, you would think based on that logic that this is plausible. Now, let's go from here. What do the technicals tell us? Well, this was the projected high for October. Did you know that? Yeah. That was the extreme projected high. Or was it? Let me just double check. I might be on the wrong time frame here. Let me double check. We got that right. Yeah, October. Okay. So check it out. Oh, no, that was the week. No, that's this week. No, sorry. That was the projected high for this week. This is the projected high for the month of October. It's good to know, right? Okay, this is the buying zone. Based on the low of the month, the projected high is here, the aggressive projected high, not a pip higher. Okay, cool. Then it dropped all the way back down to the central pivot point. In this week, by the way, I'm just now looking at weekly. So this week here, okay, based on the low, this is the projected aggressive high. Whoa, dude. So now, then we have the profit taking. And now one might assume, okay, that we're going to ride the moving averages up to the new targeted high for next week. And that is the conservative target is 162.00. The aggressive target is 162.66. That might go a little higher if we have a big day today. But to me, today is already over. So I would look at this as climbing up next week with, right, this being your take profit zone. Okay, just like this was your take profit zone. Like this was your take profit zone. Like this was your take profit zone. What do you think? Going back to Sky Killer's case, or comment, the reason like those types of strategies don't work, Sky Killer, is that the move has already happened. So you're reactionary. You're like, you don't know anything about technical analysis. You don't know anything about fundamental analysis. All you know is something broke out. I suppose it seems logical with a good pitch, but if it's already happened, it's already over. Okay? It's like guessing the lottery numbers after the lottery came out. Well, you might be, you know, it might sound like it's a winner chicken dinner, but there's just not a lot of money in it. Like, there's no prize. So anyways, yeah, the reward is doing careful, deep research. Like, think of it this way. I believe as a trader, the value we create is from our deep dive into research and thoughtful analysis. From that, we create trade plans based on bias, and we use technical analysis to confirm the time and the price, right? The price and the timing of entering and exiting our trades. So if you're skipping that somehow, like throw all that out the window and use a London breakout strategy, you have no value in the market. You're not doing anything. You're reacting to something that's already happened. You add no value. Okay? You want to, right? And then the second thing is, if you're really good with your fundamental bias and you understand why things are happening, you will have the confidence to let your winner run. And now your trades not only have worth and value because of your deep research and your ability to let your winners run, they're just simply you and your trading is worth more. Okay? Because of your thoughtfulness of your research and your ability to make good opinions, really. That's all that a bias is. In The Art of War, it says in the beginning, an honorable general will win many battles because many plans were made. It might have been, an honorable general will be victorious because many plans were made. Not because they were tough and not because, right? Right? Not necessarily because they had more, like more troops or something. No, many plans were made. I want you to think like that. I want you to have careful, thoughtful analysis that has led you to make a good decision-making process. From that, you are worth more to your clients. Your trades are worth more in money because they run longer, whether it requires no extra work. They just last longer. Because you're making decisions based on why. But this idea of like, what just happened? Oh, it's a green candle. I guess buy a green candle. No, there's no value. I mean, if there's any value, let's say a thoughtful trade is worth more and a reactive trade is worth less, maybe worthless. So I want you to focus on like, What do you want to do? You want to get rich quick? Or do you want to create value? Do you want to have a sustainable business or a ridiculous dream? Okay, the book I'm writing on how to go from poor to rich. Okay, it's going from poor to rich isn't that complicated. I'll show you all the steps, right? But I thought I'd have like a funny twist to the title of the book. I thought, right, I could call it the 55,720 quick and easy steps to becoming rich. And that thought process is what happened is I asked Google how many steps there are in a marathon. Okay, a marathon should be fairly easy. It's 55,000 steps. Just do one at a time. Follow the path. And if you can do that, you will complete a marathon. Okay? You know what I mean? Oh, BMA, I did that before the news came out. I already did that. But good morning. I covered that 2 hours ago. Anyway, so that brings me back on track here. But nonetheless, yeah, London breakout, dog and pony tricks. That's not a sustainable business, even if it was successful. There's just no value creation. And we know the secret to everything, the secret to success is creating value. But yeah, I covered all that, my friend. I think you're my friend. All right. All right. So let's do another one. Okay. We got to get above the range. Beep, beep, beep. Okay. I have to mark this new bottom though. It's important, right? Beep, 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 beep. I'm gonna pop that in there. It could be important in the future. Okay. Okay, so I'm gonna treat it like a breakout, right? So like that. Cool. All right, so let's do your trade plans. Thank you, everybody. I think this was the most recent one. Okay, okay. Let me change my colors. All right, so this trader is selling pound Aussie. Okay, let's do the technical analysis. All right, in this scenario, this is challenging. This is a challenging trade because it's so low and you're selling. Like, this is okay, but now we're at a point where it, technically, remember, I'm not looking at any fundamentals. I'm not sharing with you my bias on pound Aussie. I'm doing technical analysis. So when you're this low or this close to support, it's almost like 50-50. Okay? Like, really, it could go up from here. That would be a double bottom. Because remember, a bull can buy double bottoms or higher lows. Is that a higher low? No. Is it a double bottom? Maybe. Okay? So, is this wrong? No. So I will agree with it. This is fine. I got you. Ultimately, though, I'm not really bullish on Aussie. And I'm not really, and I'm certainly bearish here. So I'm definitely bearish here. I'm at best neutral, but maybe even bearish on this one, which means this moves neutral. So therefore, you don't really know, okay? You don't really know if it's going to go up. So I will agree with it, but that's the caveat, where I think it's really ultimately 50-50. But if you were going to do this, selling it off the moving averages on a roll reversal, okay, I'll agree with it. It's not a bad trade. It's a good, decent trade, right? Okay. Oh, I see BMA. I misunderstood you too. So you're saying, based on what Sky Killer was saying, that someone else was doing like a London breakout and they would just do a candlestick strategy, a reactionary candlestick strategy, and do no fundamentals. Is that what you were saying? Okay, I apologize. I misunderstood you. So anyways, cool. Yeah. And of course, there wouldn't have been any. What those guys usually pitch is that you don't need to know all that economic mumbo jumbo. I mean, like, think of it from my point of view. I can't imagine any professional trader that would say you don't need to know all that mumbo jumbo. I've never met a professional institutional trader that has said that. Like, you know, when I sit down with institutional traders, like we're having dinner, we rarely talk technicals. Although we all know technicals, but that just tells you price and time. So when you're out at the bars or having a cigar or having a steak dinner, you only talk about the fundamentals. You only talk about the last Bank of England meeting. You'll only talk about that stuff, right? So to have a sales pitch to retail traders to say, you don't need to know all that mumbo jumbo, it's all in the price, they're scamming you for sure. Now, that's my opinion. There might be lots of trustworthy people there that feel that way, but then if they're not scamming you, here's what they are saying. They don't understand it. They don't understand fundamentals. So they don't use it. I simply went to Harvard for 5 years and got a macroeconomics degree. That's all it took. It was only 5 years. What the hell? That's it? I've been doing this for 20. I mean, 5 years is nothing. So if I was a professional trader, I would just get a degree in economics. What's the problem? You don't have to go to Harvard, but learn fundamentals, for crying out loud. It's not hard. It takes time, takes effort, takes sacrifice. It's not difficult. Okay. All right. Let's do this one. Let's go back. Okay. Let's go back. All right. Gold. Buyer of gold at 2K. All right. Whoa. No. No. What would I do here? No. Okay. That's all I know. That's all I know. No. All right. So this is properly done. Because it's such a big candle, huh? Well, all of it is quite dangerous. So the way I teach non-farm payrolls, and by the way, I could probably bring that up right now. Where's my drawing tool? Where's my email? I have an email open somewhere, I think. Mail.google. No, wrong one. Let me go into a different one. Hang on. it's on this link, FXStreet, FXStreet, FXStreet. There we go. If you read this article, which I did not write in 2022. That's so funny. I wrote this 9 years ago. Oh, this is an interview. Oh, well, maybe I did do this last year. I must have done it last year. That's not the link then. How to prepare for and trade the employment situation report. That's 2019. All right, that's better. Although I didn't write this 2019 either, so I wrote it well before that. All right. So here's how to come up with your numbers before it comes out. So this is a conversation on modeling, how to create a model for the non-farm payrolls so that you can predict. So if you ever wondered, like the experts say, okay, the experts say something like, oh, it's going to be 180,000. How do they know that? Well, I teach you how to do your own so you don't have to rely on an expert. And then I give 2 trading scenarios, and it's this one. The continuation trade. So that's what I would recommend for this one that we're looking at. Okay? So you can see there was an open move, a pullback, and then a long. Okay, so that's the first thing that comes to my mind. You might want to read this article. Okay, again, this is how to create your own model. And then it gives you 2 trading strategies. I got to refresh this because there we go. And then it gives you some tips. Okay, so let me post this here and then I'll move on. I just wanted to show you that it's I've been teaching this for 20 years. All right, so let's go back to this trade strategy. If you were going to enter this, what I teach is that you look at this and you look at this, okay, and you do a Fibonacci study. So it's going to be from this price to that price. And this is going to be about a 382. This is going to be about a 50%. And this is going to be about a 618. And that's your buy. So I'd rather see you down here like that. Okay, this should be your trade plan. Okay, and then when you get to this, you move your stop to break even. Okay? And this is in my book now, literally this trade. When you get to this, now you jam your stop because this is likely. And, okay, and this is what you're trying for. So that's where your risk goes up, okay? Life is good. Life is great. Life is beautiful. Okay, so like, yeah, this is not a good trade set up this way because there's no trend. There's no trend yet. Okay, so you either buy the dip and that's a vol. By the way, I call that trade a high volatility event-driven strategy. You're just trading vol. It's not even a good trade. What you want is a trend trade. So you would want the higher high, higher low, ultimately, for this to be considered a good trade. The second thing is you got to be careful. Does anybody remember the hack on gold I gave you 2 hours ago? How many people want me to repeat when to know to buy gold? How many people want me to repeat that? Okay. Okay. Yeah. You buy gold when inflation is greater than productivity. So, and we'll do this for the reserve currency, right? So in the United States, inflation is 3.8 and productivity is 4.9. So you would not buy gold. Not to hedge inflation. Now, anybody can buy gold at any time. And you might say, well, it's demand. The economy is so great right now. Everybody wants to buy gold watches and gold teeth and gold jewelry. They want new cars with gold computers in them. They want laptops with gold in their computers. You want an iPhone 15. Well, that's not what Apple said. Apple said you don't want an iPhone 15. Okay? So I don't believe we're in a demand era. So I'm going to go with inflation hedge. And if inflation is lower than productivity, productivity lowers inflation, there's no inflation to hedge. So you can buy gold because you have money. You can buy gold because you want to buy gold. There's no rule. It just doesn't make any logical sense. I bought the 20-year T-note. Well, in that case it's a bond. I bought a 20-year bond that will pay me 5% a year for 20 years, and on top of that, almost certainly will appreciate in value. Gold will almost certainly appreciate in value over time. Gold can go up during a bad economy. Gold can go up in a good economy. But it won't pay you 5%. So I get back to my point where, yeah, it'll probably go up, but based on this trade, I don't know. And if you buy it at 2 and going for 7, oh my God, you're going to take all that risk to make only that much money? No. I don't like it. I don't like it. Even if it was right, that's it. You're going to take $5 out of the market? $5. By buying it near resistance? No, I can't. I can't go with that. It's not wrong, but it's definitely not right. Okay. Sorry for the long answer. All right, euro dollar. So. Ooh. Why? So we have a MACD with no moving averages. So MACD with histogram only. MACD set on 21.0? Oh, 521 over 21. Really? So you have a 521 here then, right? What moving averages are these? And it's a 1 minute. Oh my God, you use a 1 minute MACD? All right, it's a 1 minute chart. So this is only price action only. Well, look, okay, I got to break this in digestible pieces. You're doing this on a 1 minute, so I don't know how much analysis you're actually doing. So I'm going to draw a fib, and I'm going to say 382, 50%, 618. I don't see support and resistance. It doesn't go back long enough, so that's not really helpful. You have a rising histogram. I almost said Instagram. Okay, rising histogram. So you have to understand what the histogram is telling you. The histogram is saying this is almost technically bullish. That your 521 is a kiss. So I'm going to draw like a moving average, okay? And you're only doing 21 candles, so it's here. And it's very similar to this, actually. I guess this is your 521. Just doing the math of your MACD, this is a 521 or similar to it, close to it. So MACD is telling you the distance between these two moving averages are diminished, and in fact, they're about to cross up. So you're using this, so I have to use it. And does it suggest this? Is the question. Well, again, let's try to figure this out. 382, 50%, 618. That's about right. Where's the psych level? 107. Down. I'm going to have to disagree with this because and again, I'm not just making this up. So I got to go back to that article. Where did it go? The FXStreet article. This one. What you've set up here is this first one. Okay. In this one, what I suggested is the counter trend of you identify resistance before the news comes out. And then if the market expands that way on a 1 minute and then peters out, yeah, you take a shot south. But I didn't say do it down here, you know? And that's what I find with this trade. It's late, and the MACD doesn't say sell. The only thing going on here that is a sell is this. So you're projecting this way. And that's not how I would do it. So in that article, what I teach you is, you buy a pullback here or you sell a lower high here. You can't quite see that. Let me do it again. You buy a pullback here or you sell a lower high here. But trading here is dangerous because bulls and bears exist in this price. See, a bull is going to want to buy this, and your MACD kind of suggests bullishness, and a bear wants to sell it too. Right? Your entry is someone else's break even. So it's late as a scalp, and it's opposite of a continuation pattern. So, no, I'm going to disagree with it. Even though I understand it's sort of like fill a gap kind of thing. I don't like that setup that way. I wouldn't have done it that way. It's either wrong or late. Okay. So anyways, thank you for posting, everybody. Again, completely anonymous. All right. This trader is selling euro dollar, selling high. Wait, no, they mean buy. Action sell euro dollar, 107, target 106. Then why are they long? Buy. They're going to, all right, this trader's going to take some time. Okay, selling euro dollar at 107. And they didn't give me price. I can't see the price. So, all right, try to give me price, guys. All right, let's do this. First of all, when I see a chart like this and it says sell, blah, blah, no way. No way. No way. No way. Now, I'm wondering if they meant buy. No, but they didn't, though, because it's target 106. Yeah, golly. Terrible. No. Now, they're long here. I don't like this trade either, by the way. Let me pick on this trader. Okay, they bought a breakout. I hate that strategy. That's terrible. Oh, my God. No way do I like that. Now they're profitable. That's besides the point. And now they want to sell. No way. No. So what would I rather? Okay, if you're going to buy, you buy low. You buy dips. Okay? And that's what you're supposed to be using your technical analysis for. So you buy down here. Like this green candle, whoever drew that green candle, yeah, okay, this is a moving average kickoff. That's a moving average kickoff. But the reason you use moving average is to kick off of them. So let's see what else is going on. In here, this chart technically becomes bullish. I'm only interested in bullish signals. Buying at resistance is terrible. Never, ever, ever buy at resistance. Ever. Terrible. I think I made my point, right? So when you see the higher high, that makes sense. You buy the higher low at a roll reversal, maybe kick it off the moving averages. Yes. And so this line here, the reason it's terrible is if price comes down here, this trade will get knocked out of break even and I'll buy it. So this trader should have a trade on down here or be adding one here later. But buying at resistance is terrible. All right, so there's that. And then selling. Well, let me give you some basic rules here. If you're a buyer, okay, you only buy, how do you say it? Lower highs. No, higher lows, sorry. Brain fart, can't think, okay? A higher low. So it came up, it came down into the moving averages, so you're ready, willing, and able. Somewhere the moving averages cross and you get long somewhere in there. And you can see it in your MACD. I can see it in your MACD. Yeah. Okay. All right. So that's that. Now this trader wants to sell. If you're a seller, you can only sell lower highs. And their trade plan is to sell this. That's a higher high. It's one of the dumbest things I could possibly imagine. This trader's going nuts. They're like, "Oh my God, you're killing me, Wayne." Well, look, I'm trying to make a point. So I'm going to be larger than life. I'm trying to make a point. Never, ever, ever sell a lower high. Now you might say, "Well, Wayne, that's a monthly pivot point, exit." Okay, well, you didn't show that to me. And even then, it's not a sell. Okay, even if that's a pivot point zone. I've never, ever, ever recommended. Okay, now I teach a counter trend trade, but I also say I never do them, or I very rarely do them. When I invented Now, I didn't invent pivot points, but I popularized pivot points. I'm certain I'm the pivot point guy. And there was a time when I named that zone that we're talking about, the zone between, let's say, M4 and R2. I'm the first person to color them so that I knew that they were pink. I know that because I did it. It's not arrogance. I actually did it. Okay. And then when I was writing my book, so this is 2007 or 2006, I remember the exact moment. I said to myself, I want people to understand that that's not a sell zone. That was the whole point. I want people to know it's not a sell zone. It's an exit zone. And I was at a Pete's Coffee in San Mateo, California. I can picture the moment. I know the seat I was sitting in. In fact, across the street from the Franklin Templeton World Headquarters. Okay? Anyways, I'm enjoying I even remember the outfit I was wearing. Black track pants, black athletic shirt, black sweater vest. Killer, I know. All right. And I named this the Pivot Profit Zone. I really thought about it. It took me a long time as I was writing the book. And then I realized, yeah, it's not an entry to sell. It's an exit for buyers. Whoever bought it here will exit. So could you sell that? Yes, but it's not good. It's not a good idea. It's not a good trade. You will probably make money. It's not a good trade. It's very short-sighted. You can do it and make money. You will become rich, maybe, if you do it 100 times over and never lose money. But you'll never become wealthy. Burned pivot boss? Doubt it. Burned, I would go to conferences. I remember I probably had 500 people in the room. It was the first time the fire marshal had ever closed one of my meetings because too many people were getting in the room. It happened a couple of times. That was the first time. And it was at actually the FXCM Traders Expo. So I remember that. FXCM actually did a Trader Expo, Forex Trading Expo, once or twice. And I filled this room. I remember Rob Booker was doing the room across, and he had pictures of smoking monkeys, and he was throwing out T-shirts, and he was giving away prizes, and I was teaching people how to use pivot points. That's it. There was nothing funny about my presentation at all. Rob Booker was killing it, but I was teaching pivot points, and there were people sitting on the floors, and 3 people thick at the back, and a huge crowd around the door, and the fire marshal came because everyone was trying to get in. And at the end of it, people are like, oh my God, where do I get these pivot points? And it had never occurred to me, and FXCM never asked me, but at that point, they didn't have pivot points. You see, I go so far back in pivot points, I was using GFT at the time. And GFT had a custom platform. And I hired a programmer to develop pivot points for FX Bootcamp. And then I'd go around the world teaching people how to use pivot points, and nobody had pivot points. GFT, the broker, came to me and said, holy crap, we have hundreds of Forex traders all asking us to put pivot points on the platform. And they all say it's your pivot points. And I'm like, yeah. And they're like, you have pivot points? They're like, yeah, I had a custom made. They're like, can we buy them from you? And I said, I'll give them to you for free. And I did. And they became a standard indicator on the GFT platform. Many years later, FXCM switched from their proprietary platform to MT4, MT5. So I just had that made. And then, of course, that's easy to plug and play. But it goes so far backburned that I had to have them programmed for me. And having spoken at almost every foreign exchange conference around the world, I was the only one that had these. Now, there were people that used them before, but they made you pay for their analysis, which means they would just give you the numbers and then you'd go and put them onto your charts and they wouldn't tell you the formula. I told everybody the formula. I trained everybody on how to trade it and I gave everybody the indicator for free. So I don't know your pivot boss, but there was no retail Forex trading before me. And I know I'm the pivot guy. Because I've been to all the other conferences. I've spent $500,000 going to conferences teaching people this stuff. I know Pivot Boss has not. I doubt it. So anyways, going back to this. I understand this trader, what they're trying to do, but I don't like it. I don't like it. So I will disagree. Because yeah, on the long run, that's not the right thing. So I get it, but I don't like this entry and I don't like the proposed entry. So I have to disagree. Okay. Yeah. How about this, Bernd? Do you have the book? Find the book. What year was it written? That'll tell a lot. Because maybe you did. I did. I've never heard of that person. And I've been in the business for 20-something years. I've never heard of that guy. What year was it written? I'm open. Let's talk about it. Like, I'm not threatened by it. What year? S&P 500 buying. Okay. Right. Let's do this. All right. All right. All right. Yeah. Okay. So you can find me teaching pivot points on video, going back to probably 2004, 2005. Right? Let's try this. YouTube.com. What is this one? One of these. It's moving averages. Maybe it's this one. Ooh, I gotta change that. I think this one does pivot points, right? No, Fibonacci. So this one's 14 years ago. So that's about your 2010, 2010. La 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 la, ba ba da da ba. So here's 2006, when YouTube wasn't even owned by Google yet. And am I going to have pivot points on this? Yeah. All right. So this is 2006. And I already had custom-made pivot points in 2006. I mean, it was already old school. This is 2006. This is like 6 months into YouTube even being a company. Nobody heard of YouTube in 2006. You know? Yeah, there are many different pivots now, but Helen, people, if you type in Wayne's pivots, you'll see all kinds of variations of my pivots. But anyways, check that out, huh? July 24th, 2006, I already had pivot points. And they were not available. Nobody had them but me. Yeah. What was the guy's name, the Canadian? Was it Peter Bain? I think Peter Bain sold pivot points, but he sold them and he didn't teach you. And his training was pretty dumb, actually. Anyways, there we go. So this person, very bullish. Okay, we have a change going on here. So yeah, so let's take a look. So we became very bullish just recently since the Fed meeting. I'm betting on the Fed meeting. Okay. Yeah, this area I think will be the challenge. And this trader is looking left, okay, taking this and taking this and then looking right. So looking left, you would say, no, 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 no. And then looking left, you'd go, no, 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 no. Okay, golden. And they've already projected up. So a down, so a bit of an up, I think, with a down. So they have a plan A, plan B. Love it. Yeah, I see the A and B. I see it. Nice. All right, so there's a lot of colors. So their plan A is this and their plan B. Yeah, that's all I can say. I think there's going to be a challenge once we get to 44 and a big dip to 42.50, plausible in the works. Yeah, okay, fine. Then we look at, oh, it's a weekly central pivot point to a weekly target of 44.38. Love it. Quant Box says it's very bullish. This trader sees a green candle and they're waiting for red candles. Patience, discipline, focus, trend trading, fundamental analysis. Brilliant. Love everything about it. Great job. Very proud of that trader. That's like, yeah. But there's still, I mean, look, it's not like that's like going to make money. There's work here. Like we got to get through that. That's going to be a problem. But they're going to buy a dip. Yeah. They're going to buy a dip. That is a margin of safety. I mean, yeah. So therefore they can take the risk. Love it. Oh my God, is it 10:30? I'm supposed to end now. Oh my God. One more. Let me go fast. Let me go fast out of respect for our moderator. Let me go fast. No more babble. Okay. Let me double check their bias. Buying gold. Okay, let's do buying gold. Okay, let's go. Up, 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 down, down, buy, 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 up, up, down, down, buy, up, up, boop, 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 boop. Don't like it, don't love it, not yet. It's either too early or too late. I can't really tell. There's nothing technically here to help. Price action isn't very good. And so, no, I'm going to disagree with it. It's a bit of a guess, and it's way too high to buy. Okay, let's go here. All right. Oh, I forgot. Buying Aussie dollar. Okay, let's do it. Let's take a look. Okay. On a 15-minute chart. No. So, all right, let me try to, I think it did this and then they bought. I don't like how it was entered, but it is low. But I feel like they did it before the news. So I'm going to say, no, I don't like that. And then the other thing is, now that it's there, they're buying here. No, I don't like that. No. You can only buy higher lows. So you buy down here, or you buy here. It's the same price, but way less risk. So like seeing a trader do this, don't like it. In fact, I very much dislike it. And buying this, guessing, no, this is no disrespect. Like I didn't see exactly how that went down, but if it went down the way I think it did, it's degenerate gambling. It's not good at all. All right. Buying euro yen. Well, okay. Okay, we have the higher high. So as a bull, you're allowed to buy a higher low. So I expect to see a trade in here somewhere. I don't see a trade, and this is quite late. Okay. 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 It's a bit late. Can I disagree with it? I like the role reversal. What's their entry? Entry 58.66. 58. Oh my God. Well, they're way down here. 58.66. Okay. I mean, yeah. But there should be a new trade on this. So they're already in this trade. 58. Like they're in down here, unless they did this. So that's 59, 50, 58, 66. 50, no, it didn't get anywhere in there. So they're down here. I guess somewhere in here. Okay, 58.66. 58.66. Yeah, so they got one here. Okay. Yeah, okay. Yeah. And then they survived this. I guess my only hesitation is you got one here. You should have another one here. Okay. You should have a second one. So, okay. Yeah. Good. All right. Moving on. Moderator, kick me out if you have to. If you need to go and you're like, dude, this guy, got to stop him. If you got to go, moderator, no harm, no foul. Your life is important. If it's time to go, let me know and I'll end the stream. I'll just keep going very quickly. I'll go quickly. Okay, so let's go back to this. Pound Kiwi, question mark. Okay, I'm actually bearish on both of these, but I also know pound, and I get caught up on cross pairs. So I'm thinking about this fundamentally, and it doesn't make any sense. I'm basically bearish on both. So selling, okay, fine. Selling, 207. Okay, yeah. Okay, we have a higher high. We have a lower high. We have a lower high, lower high. So this trader is going to do one of these things. I get it. That's fine. That makes sense. It makes no sense fundamentally. And I have my doubts because I can't predict that that's going to happen. All I can tell you is it has been happening. So yeah, I guess so. I've seen worse trades, but again, it doesn't make any sense fundamentally. Did we already see this one? It looks like the same one. I'm going to skip it like we already saw it. Maybe it's a different asset, but it looks like the same trade. No. I looked at it in 1 second. No. Okay. Let's take a look at this. Pound yen daily. What? Okay. What are they doing? They're buying. Buying what? They're buying 181, basically 182, 181, buying 180. What? So they're already in. No. I can't. I will not condone a course of action that will lead us to war. No, this was bearish at the time. And we had this and this. And no. So if you were going to do this, it would have been like the role reversal after the higher high. So I would have recommended like, okay, 83 basically. Let's kill this. 83 after the higher high. Drop down into 83 and riding the moving averages. That's what I would do if I were me. Buying this, no. It's not low enough to be a range trade. I can't see how that went down. I know there's an assumption maybe of the pivot and stuff, but there's no technical analysis there that confirms it. The only thing I have is this predicts that. So, sorry. Niet. Okay, even though it worked out, congratulations. All right, we're done. Oh, that was so awesome. Yeah. Anyways. All right. I love you, babe. That was real, but I got to jump. Thank you to our moderator. World's greatest moderator. Nobody moderates like our moderator. In fact, there's nothing moderate about our moderator. We have an extreme moderator. Extreme excellence. I'd like to thank FXstreet for hosting this webinar that I've been doing with them for 17 and a half years. Okay? I'm doing everything I can to help. I do many free services. I do paid services. I write books. I go on tours. I do lectures. I'll be in Nashville, Tennessee in December. Looks like I'm going to be speaking at the London School of Economics in February or March. I get around. I probably want to be in Miami in March as well. Whoa, wouldn't that be cool to go from London to Miami? Oh my God, there's so much I try to do. I'm writing books. Okay. I can't tell you, I'm going to do something with FXstreet very special very soon. It's going to blow your minds. I try hard every day to get out of bed and do the things that need to get done. And priority number one is help you grow as a Forex trader. So thank you for being in my life. Thank you for the hard work you put into this. This is a tough gig. I've been doing this a long time and it hasn't gotten easy, but I have automated things. So like you saw tradeplans.ai, it's amazing. You've seen quantbox.co. It's amazing. These are automations. One is focused on technical analysis. The other one's focused on fundamental. You find me at Investor Bootcamp. There's 100 hours of training for $88. It's so stupidly cheap. It's ridiculous. People don't pay for it because they think it's going to be crap because it's only $88. Well, know this. People in this chat have paid $1,000 for it. I lowered it to $88 during COVID, and now I've kept it there. I don't know why. I'm stupid. But take advantage of all these resources. You don't have to reinvent the wheel. You got FXstreet. You got Investor Bootcamp. That's all you need. Okay? So you can check me out there. You can check me out at Trader's Way. How about a broker that doesn't trade against you? That sounds pretty good. That's a good business model for a service provider. Symbiotic. So, peace on earth. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful weekend.